Hello, I'm John A.G., and I want you to imagine a market so tightly wound that even a small disturbance sends shockwaves through the entire system. Imagine a market where demand keeps pressing forward no matter how many barriers are placed in its way, where every attempt to calm things down only reveals how fragile the structure really is. That is where silver finds itself right now. China didn't pause silver trading for a few minutes. It didn't slow it down for a technical reset. It shut it down for the entire day. And that single decision tells you far more about the state of the silver market than any headline about price movements ever could. Because when a market authority steps in that aggressively, it isn't acting out of confidence. It's reacting to pressure. And the real question isn't why trading was halted. The question is, what happens when halts no longer work? What happens when demand keeps building, even after the doors are temporarily closed? If you've been watching silver over the past several weeks, you already know how disorienting this moment feels. One minute the price is holding firm, reinforcing long-held convictions about supply shortages and industrial demand. The next minute, the market experiences one of the most violent sell-offs many traders have ever seen. Prices collapse in a matter of hours, confidence is shaken, and suddenly the narrative flips. Doubt creeps in. People start asking whether silver was misunderstood, whether the thesis was flawed, whether this entire move was just another false start. Then, almost immediately, the headlines shift again. China halts trading. Premiums explode, physical metal disappears, vault inventories fall, delivery times stretch out, and none of it seems to line up cleanly with the price you see on a screen. That confusion is not accidental. It's a symptom of two very different markets moving in opposite directions at the same time. The story being pushed is simple. Silver ran too hot. Regulators stepped in, excess speculation was cooled off, stability was restored, end of story. But that version ignores the sequence of events that led here. And when you line those events up in order, the picture that emerges doesn't look like orderly regulation, it looks like containment. This week, Chinese authorities suspended trading in 5 commodity-related funds. Among them was the UBS SDIC Silver Futures Fund. That matters because this fund is not just another investment vehicle. It is the only publicly accessible fund in mainland China that provides direct exposure to silver futures. When Chinese investors want silver exposure inside the domestic system, this is where they go. That fund was halted for an entire trading day, not for the first time, but for the second time since late January. Before that, it had already faced warnings, temporary pauses, and repeated risk alerts. The official reason given was excessive premiums. At the time of the halt, the fund was trading at roughly a 36% premium over the underlying silver contracts on the Shanghai Futures Exchange. Think carefully about what that means. Investors were paying more than a third above the value of the metal itself just to gain exposure through this fund. Not because silver had suddenly become more valuable in physical terms overnight, but because demand had overwhelmed the available channels. That kind of premium is not normal. It is not healthy price discovery. It is a signal that too many people are trying to access too little supply through too few doors. When regulators see something like that, they face a choice. They can allow prices to rise and let the market clear itself, or they can intervene by restricting access and hoping enthusiasm fades. China chose intervention. Trading was halted. New inflows were blocked. Warnings were issued. Pressure was temporarily relieved. But none of this happened in isolation. It happened immediately after one of the sharpest paper-silver sell-offs in modern market history, a move so fast and so aggressive that experienced traders openly admitted they had rarely seen anything like it. Price collapsed at a moment when liquidity was thin, margin requirements were raised, and positioning was heavily skewed toward leveraged longs. That sell-off did exactly what it was designed to do. It flushed leverage out of the system. Margin calls forced liquidations. Weak hands sold in panic. Confidence cracked, and those closest to the market's plumbing were able to reset positions at much lower prices. What didn't happen, though, was demand disappearing. In fact, the opposite occurred. The crash acted as fuel. Dealers reported order volumes doubling and tripling almost immediately. Some were forced to temporarily close order books because they couldn't process the surge. Physical premiums jumped. Inventories drained. Delivery delays stretched into weeks. This is the disconnect most people miss. The paper market collapsed. The physical market accelerated, and that divergence is the core of the story unfolding now. The paper-silver market is built on futures contracts, leverage, and margin rules. Prices can be driven sharply lower or higher based on positioning, liquidity, and regulatory changes without any immediate connection to physical availability. The physical market operates on entirely different constraints. Real metal must be mined, refined, transported, and delivered. When demand exceeds supply, price pressure builds whether or not futures charts acknowledge it. Under normal conditions, these two markets move closely enough together that the difference hardly matters. Under stress, they separate. And when they do, the paper price can become detached from reality. Right now, inventories at the COMEX, the main U.S. futures exchange for precious metals, are hovering near historic lows. Registered silver, the metal actually available for delivery against contracts, sits just above 100 million ounces. That number sounds large until you compare it to global industrial consumption, which can absorb that amount in a matter of weeks. Each time paper prices are forced lower through liquidation events, physical buyers step in more aggressively. Industrial users secure supply. Investors remove metal from circulation. The very act of suppressing price accelerates the drain on inventories. This is where the narrative breaks down. Suppression doesn't eliminate demand, it concentrates it. China's situation makes this dynamic even clearer. Domestic investors face capital controls and limited access to foreign markets. Their ability to buy silver through overseas futures exchanges is restricted. Their domestic options are narrow. When demand rises, it floods into the few available vehicles. That is why the UBS SDIC fund traded at such extreme premiums. Those premiums are not speculative excess alone. They are signals of constrained access colliding with rising demand. Regulators didn't step in because everything was fine. They stepped in because they saw what happens when pressure builds in a closed system, and that pressure has not gone away. Silver's industrial demand continues to grow. Solar manufacturing consumes increasing amounts of silver paste. Electronics rely on silver contacts. Electric vehicles require silver components. The broader energy transition that governments have committed trillions toward remains silver intensive. None of that demand disappeared because of a sell-off or a trading halt. What did change is visibility. The stress fractures are now out in the open. The market's attempts to manage perception are becoming harder to maintain. The timing of the sell-off also matters. Margin requirements on precious metals futures were raised just as volatility increased. Higher margins force traders to post additional capital or exit positions. When many traders are positioned the same way, that creates forced selling. Forced selling cascades. Prices fall further, triggering more margin calls, accelerating the move. This is not a conspiracy, it is structural. The system rewards those who can withstand forced liquidation and punishes those who cannot. When you combine margin hikes, thin liquidity, heavy leverage, and convenient headlines, you get precisely the kind of waterfall move silver just experienced. And while that move was devastating for paper longs, it was a gift to physical buyers. China's halt did not cool demand, it confirmed it. And this is where the first real question emerges. If halts, margin hikes, and engineered sell-offs fail to destroy demand, what tools remain? That is the question the silver market is quietly forcing regulators and institutions to confront. What makes this moment especially revealing is that the pressure isn't coming from a single source. It's coming from multiple directions at once, and that convergence is what turns an ordinary market dislocation into something more consequential. On one side, you have physical demand steadily increasing, driven by industrial use and long-term investment behavior. On the other, you have a paper system that depends on confidence, rollover, and the assumption that most participants will never ask for delivery. When those two sides drift too far apart, the system begins to strain. This strain became visible in the futures market almost immediately after the sell-off. Open interest in silver contracts collapsed. Within days, the number of outstanding contracts fell from over 300,000 to under 100,000. That represents an enormous reduction in paper exposure, equivalent to hundreds of millions of ounces being removed from the futures complex. That kind of contraction doesn't happen because traders suddenly lost interest. It happens because participants are actively trying to reduce risk, and risk in this context means delivery. The March contract was a major delivery month. As it approached, turnover exploded. Contracts were opened and closed at a pace rarely seen in stable markets. Turnover exceeded 300%, meaning the same positions were being flipped multiple times in a short window. This wasn't healthy liquidity, it was avoidance behavior. Traders who were short silver paper did not want to be anywhere near a contract that might result in physical settlement, so they exited quickly. This is the part of the market mechanics most retail investors never see. Futures markets function smoothly as long as most participants treat contracts as financial instruments rather than claims on metal. The moment that assumption weakens, behavior changes. Positions are unwound. Liquidity evaporates. Volatility spikes. Meanwhile, physical buyers were doing the opposite. They were stepping in. Refiners were locking in supply. Industrial users were securing forward deliveries. Investors who understand the difference between paper price and real availability were using the crash to accumulate. This divergence is why price alone can be misleading. A falling paper price during a physical shortage is not a sign of abundance. It is a sign of stress. At the same time all of this was unfolding, institutional commentary began shifting. Citigroup released projections suggesting silver could reach $150 within a matter of months. Their reasoning wasn't emotional, it was structural. They pointed to Chinese retail behavior, noting that it mirrors momentum-driven participation seen in U.S. derivatives markets. When price begins moving, buying pressure compounds, and with limited supply, price adjustment can become violent. This is not fringe speculation. When a major global bank acknowledges the potential for a move of that magnitude, it tells you something important. It tells you that the imbalance between supply and demand has reached a level that even conservative institutions can no longer ignore. Yet at the same moment these projections surfaced, regulators were acting to slow things down. Trading halts, margin increases, risk warnings, messaging about excessive speculation. This apparent contradiction confuses many observers. How can silver be structurally undervalued and simultaneously too dangerous to trade? The answer is that both can be true at once during a transition phase. The existing pricing mechanism relies on futures markets to set the global reference price. That system works as long as physical supply can meet contractual obligations and confidence remains intact. When confidence erodes, authorities attempt to stabilize the mechanism not because the underlying asset lacks value, but because rapid repricing threatens systemic stability. In other words, intervention is not proof that silver is worthless. It is evidence that silver matters. China's actions fit this pattern perfectly. The halt was framed as investor protection. Excessive premiums were described as unhealthy. But the deeper concern was control. When a single fund trades at a 36% premium, it signals demand that cannot be absorbed without price escalation. And price escalation attracts attention. Chinese authorities are acutely aware of what happens when capital crowds into hard assets during periods of economic uncertainty. Property markets have struggled. Equity markets have disappointed. Currency confidence has weakened. Precious metals become a release valve. Silver is particularly sensitive because it is smaller, thinner, and more volatile than gold. It moves faster, it breaks sooner. That is why silver often leads during periods of monetary stress. It reacts not just to inflation expectations, but to trust. Trust in paper promises. Trust in policy stability. Trust in the idea that financial assets will behave as expected. Once that trust begins to erode, behavior changes. Investors stop asking what something is worth today and start asking what it might be worth when conditions worsen. This is where the gold to silver ratio becomes relevant. Historically, during periods of financial stress or monetary realignment, the ratio compresses sharply. At present levels, it remains elevated. Even with silver's recent moves, it still takes roughly 75 ounces of silver to purchase 1 ounce of gold. In previous cycles, that ratio has fallen dramatically. During the Hunt brothers episode, it briefly approached 15. During other periods of monetary uncertainty, it has moved into the 20s and 30s. The implication is straightforward. If gold holds value while the ratio compresses, silver must rise disproportionately. This is not a prediction. It is arithmetic. If gold remains near current levels and the ratio merely reverts toward historical norms, silver prices move into territory that today feels implausible to many observers. That implausibility is precisely what creates opportunity. But opportunity does not arrive without volatility. The path is rarely smooth. In fact, the more distorted a market becomes, the more violent the adjustments tend to be. This is why attempts to trade silver purely on short-term price action are so dangerous. The environment is hostile to leverage. Rules change quickly. Margin requirements can spike overnight. Trading can be halted without warning. Positions can be liquidated before participants have time to react. For those operating on short time frames, risk management is not optional. It is survival. For longer-term participants, the calculus is different. Volatility becomes a feature rather than a bug. Pullbacks are not signals to flee, but opportunities to assess whether underlying conditions have changed. In silver's case, they have not. Supply remains constrained. Industrial demand remains robust. Inventory levels remain low. Paper mechanisms remain under strain. What has changed is awareness. More participants are beginning to understand that futures prices are not guarantees. They are references, and references only hold as long as confidence holds. This shift in understanding is subtle, but powerful. When enough market participants internalize it, behavior changes, physical demand increases, willingness to hold through volatility improves, sensitivity to paper price declines. This is the stage where suppression becomes less effective. Each engineered sell-off removes more metal from circulation. Each intervention accelerates the very process it seeks to control. That is why China's halt should not be viewed as a conclusion. It is a symptom, a sign that pressure is building faster than authorities would like. The system can slow the release, it can delay the adjustment, but it cannot eliminate the underlying imbalance. At some point, price must reconcile with reality, and that reconciliation rarely happens gently. As we move forward, the critical question is not whether silver will experience more volatility. It will. The question is whether the mechanisms designed to manage that volatility remain credible in the face of sustained physical demand. That question is now open. And markets do not like unanswered questions. The most important signals in markets rarely announce themselves loudly. They show up quietly, buried in data points most people ignore, unfolding over weeks rather than minutes. That is exactly how the silver story is progressing now. While attention swings between crashes and rebounds, the deeper mechanics continue to tighten beneath the surface. One of the clearest indicators of this tightening is the state of registered silver inventories. These are not abstract numbers. Registered metal represents silver that is actually available to satisfy futures delivery obligations. When that category declines, it means fewer ounces remain that can be handed over if contract holders demand settlement. Recent figures place registered inventories near 104 million ounces, a level that sits uncomfortably close to historical lows. In isolation, that number might not seem alarming, but context matters. Global industrial demand alone can absorb that quantity in a relatively short period of time. Add investment demand, strategic stockpiling, and supply disruptions, and the margin for error shrinks dramatically. This is why the behavior of futures traders during the recent sell-off matters so much. The collapse in open interest was not simply a loss of enthusiasm, it was a reduction in exposure driven by delivery risk. When traders close positions en masse ahead of delivery months, it reflects concern about physical availability, not just price direction. The paper market is designed to function on the assumption that most participants will roll contracts forward or settle financially. Physical settlement is supposed to be rare. When it stops being rare, the entire structure begins to wobble. This wobble is already visible. Each delivery cycle requires more maneuvering. Turnover rates spike. Positions churn rapidly. Liquidity thins. Volatility increases. These are not signs of stability. They are symptoms of stress. At the same time, the physical side of the market continues absorbing metal at a steady pace. Industrial users do not care about short-term price fluctuations when supply reliability is at stake. Manufacturers secure material to keep production lines running. Delays cost more than premiums. Investors who understand this dynamic behave differently as well. They stop viewing silver as a trade and start viewing it as inventory, something to hold, not flip, something to secure, not chase. This behavioral shift is subtle but transformative. Markets are shaped not just by prices, but by how participants interpret risk. When risk shifts from price volatility to availability uncertainty, priorities change. That is why the attempts to frame recent events as speculative excess fall short. Speculation does not cause inventories to drain. Consumption does. Protection against systemic risk does. Chinese investors are not unique in this regard. They are simply operating under constraints that make the signals more visible. Capital controls limit alternatives. Domestic vehicles are few. When demand rises, pressure concentrates quickly. The 36% premium observed in the UBS SDIC fund was not created by hype alone. It was created by necessity. Investors seeking silver exposure had limited options. They bid up what was available. Halting trading did not eliminate that desire. It merely postponed expression. The same pattern exists globally, though it manifests differently. In the United States, access is broader, but leverage is higher. Futures markets offer exposure, but at the cost of vulnerability to margin changes and forced liquidation. In Europe and elsewhere, regulatory frameworks vary, but the underlying issue remains. Physical silver is finite. Demand is persistent. Paper claims are elastic until they are not. This is why suppression narratives ultimately fail. You can influence price temporarily. You cannot print metal. Over time, persistent demand reshapes the market. Premiums remain elevated. Inventories decline. Delivery risks rise. And eventually confidence in paper pricing erodes. This erosion does not happen all at once. It happens in stages. First, anomalies appear, premiums disconnect, delivery delays extend, then volatility increases. Finally, participants begin questioning whether the reference price reflects reality. We are now firmly in the anomaly stage, moving toward the volatility stage. The gold-to-silver ratio reinforces this interpretation. Despite recent moves, the ratio remains stretched by historical standards. This suggests silver has not yet fully repriced relative to gold. Gold tends to move first during periods of monetary stress. Silver follows with greater intensity. This pattern has repeated across centuries. It is not guaranteed, but it is persistent. If gold continues holding value near current levels, even partial normalization of the ratio implies substantial upside for silver. This is not about targets, it is about probability distributions. Markets do not move from undervaluation to fair value in straight lines. They overshoot. They correct violently. They test conviction. That is why positioning matters more than prediction. Being forced out of a position at the worst moment is how long-term opportunity is lost. Leverage increases vulnerability. Overconfidence magnifies drawdowns. Emotional reactions amplify mistakes. The participants who survive transitions are not those who guess correctly every time. They are those who structure exposure so they can endure volatility without being forced to act. This is especially true in a market like silver, where interventions are frequent and surprises are common. Trading halts, margin hikes, and regulatory warnings are tools used to manage perception and pacing. They are not tools that resolve imbalance. Each intervention buys time. It does not create supply. Over time, the cost of delay increases. Industrial demand does not pause. Technological adoption continues. Monetary uncertainty persists. Silver sits at the intersection of these forces. It is both an industrial input and a monetary metal. That dual role makes it uniquely sensitive to systemic shifts. This sensitivity is why silver is volatile. It is also why silver is informative. It reflects stress early. What we are witnessing now is not the end of a cycle. It is the middle of a repricing process that has yet to resolve. The paper market can continue producing violent moves. Physical demand can continue draining inventories. Regulators can continue attempting to smooth the path. But the underlying arithmetic does not change. Finite supply meets persistent demand. Eventually, price adjusts. The uncertainty lies in timing and path, not destination. This is where patience becomes an advantage. Understanding the structure allows participants to view volatility differently. Crashes are not verdicts, they are tests. Each test removes weak positioning. Each rebound confirms unresolved pressure. China's halt was one such test. The sell-off was another. Neither resolved the imbalance. Both exposed it. As more participants recognize this, behavior shifts further. Futures markets lose dominance. Physical markets gain influence. Reference prices adjust. This transition is rarely comfortable. It challenges assumptions. It punishes complacency. It rewards preparation. The silver market is sending signals, not through headlines, but through mechanics. Inventory levels, premiums, open interest, delivery behavior, those signals are consistent. They suggest strain. They suggest imbalance. They suggest a system approaching its limits. The question each participant must answer is not whether volatility will continue. It will. The question is whether they are structured to endure it. Because when repricing finally asserts itself, it does not wait for consensus. It moves quickly, often after exhausting patience. And when it does, the opportunity is no longer theoretical. It is already priced in. That is the phase silver is approaching now, not the end of the story, the turning point.